Hey, welcome back to the Consulting Mind. Today, I'm going to share with you all you need to know about the Libor-OIS or the overnight index swap spread. So, let's begin with why does the spread matter to you as an investor? As Alan Greenspan has put that previously, the Libor-OIS spread remains a barometer of the fears of bank insolvency. What does that mean? The term Libor and OIS spread is assumed to be a measure of the health of banks because it reflects what banks believe it is the risk of default associated with lending to other banks. So let's take an example. You can see from the right hand side of the slide the Libor OIS spread from 2006 to 2010. You can see the Libor spread has been surging since the beginning of the financial crisis. And you can see before the crisis, the spread is way below 1%, roughly at 10 or 30 basis points something. But at the peak of the financial crisis, it can surge as high as 300 basis points or close to 400 basis points. And it goes down again when the crisis is over. And back to 2010, it resumed to the level of below 100 basis points. So in short, we can see that the Libor and OIS spread goes up when the credit risk within the banking sector goes up, or vice versa. The credit risk of the banking sector will trigger the surge of the Libor and OIS spread. Okay, that's the basis. So let's go into the details and of the Libor and OIS. Libor is the average interest rate that the bank charge each other for short-term unsecured loans. The Libor is designed to provide banks around the world with an accurate picture and indication of how much it costs to borrow short-term funding. In each day, several of the world's leading banks will report what it would cost them to borrow from the other lender on the London interbank market. So, effectively, Libor is the average of these response from the large bank. And on the other hand, the OIS overnight index swap represent a given country's central bank rate over the course of a certain period. And in US, the Fed fund rate is the key interest rate controlled by the Federal Reserve. So, if a commercial bank or a corporate entity want to convert from a variable interest to a fixed interest payment or vice versa, it could swap the interest obligation with a counterparty. For example, a US entity may decide to exchange a floating rate, the Fed fund effective rate, for a fixed one, let's say the OIS rate. So that's the relationship between the two indicator. So what happens now? You can see since the 2020 start, the Libor and the OIS spread has been surging again. And what does that mean? It means that there are some perceived risk within the banking sector emerge again. So as an investor, the Libor and the OIS spread is a must-watch indicator for you to understand the overall healthiness of the financial sector and financial industry. And it is a very strong indication of how the market is going to do in the future. So hope it helps.